Okay, let's move on to Chapter 5. The first exercise assigned reads, determine the current year. During the current year, merchandise is sold for 8.1 million. The cost of goods sold was 4.698 million. What is the amount of the gross profit? Well, you just take your sales minus your cost of goods sold, and you get 3.402 million. Compute the gross profit percentage. Well, you're just taking the gross profit then, the 3.4, divided by the sales of 8.1, and you get 42%. Will the income statement always report operating income? Obviously not, no. If operating expenses are less, then there will be income. All right, number 2. For a recent year, Best Buy reported sales of $39.528 million. Its gross profit was $9.191 million. Well, then we back into the gross profit. Again, so you got sales is always the item that we start with. Sales minus cost of goods sold equals our gross profit. So if they give you that number and this number, we back into cost of goods sold. All right, moving along, our next exercise assigned, I believe, was number 4, and it reads, the stationery company purchased merchandise on account from a supplier for $14.5. Terms are 210 net 30. The stationery company returned merchandise with an invoice amount of $3,500 and received full credit. What is the amount of cash required for the payment? So we purchased a total of $14,500, and we also received our 2% discount. So we know that we take away the 2% discount. The net, if we didn't return anything, what we'd actually have to pay is $14,210. However, we also returned $3,500. But we also take off that 2% there as well, because we no longer have that inventory, but at the same time, we cannot also not take off that 2%. So the net purchase of all of this would be $10,780. So you take off the 2% of the original, but when you returned it because, for whatever reason, but you put it in with a 2% off as well. So you can't return it for full credit when you took the inventory with the 2% off. Otherwise, you are actually double dipping. So in this case here, you purchased it for $14.5, you take the 2% off, but then when you return it, you don't return it at full credit, you return it at your discounted price. So what amount? $10,780. Under a perpetual inventory system, what account is credited when we record a return? Well, of course, we use the inventory account. Number 5, purchase related. So a retailer is considering the purchase of 1,000 units of a specific item from either of the two suppliers. Their offer is as follows. Supplier 1, $34.80 a unit, 110 net 30, no charge for freight. Supplier 2, a little bit more per unit, a little larger discount, 210 net 30, but there is freight. So which one yields the lower price? So first one, supplier 1, $34.8, and we're buying 1,000 units, so we got $34,800. There is a 1% discount, so we show the discount. There is no freight, so the net is $34,452. The second one is a little bit higher. It's $35 a unit. There's a 2% discount, so 2% times 35,000 is $700. However, there is an add for some freight. We add the freight to the cost of the inventory. So the net cost here is $34,500. So you see the one there is just ever so slightly less than the other. So in this case, which one would they probably go with? The supplier 1 is just a little bit less. Number 6, purchase-related transactions. The debits and the credits from 4 related transactions, 1 through 4, are presented in the following T accounts. Assume that freight charges were FOB shipping point and that the credit terms were 110 net 30. Describe each transaction. Okay, so number 1, you see there's a debit to inventory for $13,860 and a credit for $13,860. Well, they bought merchandise on account net of the discount. Net of the discount, there's 110 net 30. So we put it in net of the discount. So we have to figure out by adding 1% back to figure out exactly what is the cost of the inventory. In this case, $13,860, or a gross amount of $14,000. Number 2, there's a debit to inventory for $150 and a credit to cash. For $150, they paid it right away with cash. That would be for freight. Add the freight to the cost of the inventory. Number 3, accounts payable was debited for $19.80 and inventory was credited for $19.80. To me, that would sound like a return, an allowance for the return of merchandise. And then lastly, number 4, they debited cash for $11,880 and they debited accounts payable for $11,880 and credited cash for $11,880. This would be paying now all that inventory that we put into our accounts payable, the inventory that we purchased on account. So there was $13,860 put into accounts payable. We returned $19.80, and that left us with $11,880 due. So we credit cash for that and debit accounts payable. Number 7, purchase-related transactions. All right, this woman's supply clothing store purchased $48,000 from a supplier on account, terms FOB destination, 210 net 30. They returned some merchandise with an invoice amount of $7,500, receiving a credit memo. Journalize the entries to record the purchase, the return, the payment within the discount period, and then the payment beyond the discount period. All right, so number 7. First, we record the inventory net of the discount. We purchased $48,000. There was a 2% discount. Debit inventory, credit AP. Then we returned $7,500. Well, we take it out of AP because we haven't paid it yet. Take it out of inventory, net of the discount, $7,350. Then our net is, in letter C, the payment. Well, get rid of the AP. We credit cash for that net amount, $39,690. Now in this case, letter D is a little interesting. We didn't do it within the window of 10 days. So in this case, all we have to do is we still will get the AP out, $39,690. That's still the same amount. Nothing has changed there. However, we put it into inventory with that 2% discount, assuming that we were going to pay it within 10 days. We didn't. So therefore, that 2% needs to be added back. So what we have to do is put it back into inventory. We put inventory back. We have to add that 2% discount back to the cost of inventory for $810. $810 is added back, and then cash then is credited for the actual full amount. So if you had a hard time trying to figure out what the $810 is, then you could simply do it this way. First of all, you have to get the AP correct. We knew we put it in at $39,690, so we got to take it out. Well, then our cash is going to be exactly the full purchase price, because we didn't take advantage of any discount, so it's the full purchase price less the full return. So in that case, it is 40,500 that we need to return back to the supplier. So in this case, our debit is to $39,690, inventory is debited for $810, and then we credit cash for $40,500. Okay, moving on to number 9. Number 9. It reads here, sales-related transactions, including the use of credit cards. Okay, not too much new here. Letter A, sold merchandise for cash, $25,000, cost $17,500. So, like we've always said, whenever you do inventory, a sale of inventory, there's always two transactions. Debits cash, credit sales, debit cost of goods sold, credit inventory. Nothing new. Sold merchandise on account, $98,000, cost of goods sold, $58,800. So now it's on AR and same cost of goods sold inventory. Whenever we sell inventory, there's always two transactions. The sales transaction, and then the cost transaction. So here's the sales and then the cost. Sales, cost. Letter C, sold merchandise to customers whose MasterCard and Visa, who use MasterCard and Visa, $475,000, cost of goods sold $280,000. All right, whenever it's credit card sale, that's cash. So here is your sales transaction, $475,000, your cost of goods sold, and they told us that was also $280,000. Letter D, sold merchandise to customers who use American Express. Again, cash, $63,000. The cost was $39,000. Here's your cost, $39,000. Very much, you see A through D, very repetitive, virtually all the same. Received an invoice from this National Clearinghouse for $13,450, which is the fee paid for using the credit cards. So they take it directly out of your cash account, and you would just debit credit card expense. So the use of all the credit cards cost the company $13,450. Number 10 reads, on December 28, Silverman Enterprises sold $18,000 of merchandise to Beasley with the terms 210 net 30. The cost of goods sold was $11,200. On December 31st, Silverman prepared its adjusting entries, yearly financial statements, and closing entries. On January 3, Silverman Enterprises issued Beasley a credit memo for returned merchandise. The invoice amount of the returned merchandise was $4,000, and the merchandise originally cost Silverman $23.50. Letter A. Journalize the entries by Silverman to record the December sale. Journalize the entries by Silverman Enterprises to record the merchandise returned. Letter C. Journalize the entry to record the receipt of the amount due by Beasley on January 7. Okay, so number 10, letter A. It says, journalize the entries by Silverman Enterprise to record the December 28th sale. Okay. Well, we know what the sale would be. So if you look at the solution here, it doesn't have the sale on there. We sold it, so sold the $18,500 of merchandise to Beasley, terms 210 net 30. I just realized I read the wrong one. That was number 11. So here's the sale. If you look at number 11, here's the sale. And it shows here the AR and the sale net of the discount. B, here's the cost of goods sold. So there was A. Let's go back. I'm sorry, number 10. Singer Company sold merchandise of $15,500, terms 210 net 30 to Burris. This Burris paid Singer for merchandise on May 2. On May 12th, they paid Burris $650 for the costs incurred by Burris to repair the defective merchandise. Letter A, journalize the entry by Sanger Company to record the customer refund. So in this case, we will credit cash for $650 because Sanger paid Burris $650 for costs incurred by Burris to repair the defective merchandise, paid $650, and then there's a debit to a new account called Customer Refunds Payable. Letter B, it's just slightly different. It says, assume that instead of paying Burris cash, Sanger issued a credit memo to Burris to be used against their outstanding AR. So in this case then, we will reduce their AR by $650. It's still a debit to the customer refunds payable. So again, just read here, it says Burris paid Sanger for the merchandise on May 2, but on May 12th, Sanger paid Burris $650 for costs incurred to Burris to repair defective merchandise. So they paid it. Here in letter A, they paid it. And then they debit a customer refunds payable. And the difference in letter B is they just reduced their AR. They just reduced their AR. All right, we're going to skip over 11, even though we did half of it. And then number 16. Showcase. A furniture wholesaler sells merchandise to Balboa on account for $254,500. Terms net 30. Cost of goods sold $152,700. Showcase issues a credit memo for $30,000 for merchandise returned prior to Balboa paying the original invoice. The cost of the merchandise is $17,500. Journalize the entries for A, the sale. So here we go. Whenever there's an inventory sale, there's two transactions. So we debit AR, credit sales, debit cost of goods sold, credit inventory, the sales amount, the cost amount. Letter B, the credit memo including the cost of the merchandise. So first, we returned $17,500. That was the cost. So we put the inventory back in at its original cost. We credit a new account called Estimated Returns Inventory. And then we also need to reduce their AR because they don't owe as much anymore. The cost was $17,500, but it had a sales price attached to it. It says a credit memo of $30,000. So we reduce AR by $30,000, and then we use this new account called Customer Refunds Payable. So we first put it back into inventory, and then we reduce essentially the sale. I'm just going to point something out here for what other companies might use instead of some of these new accounts. And this will make sense after you see it. If you look at letter A, we debit AR, we credit sales. So you return it, you essentially are doing it right here in letter B, the first part, where you remove the receivable, because you put it in there, now you remove it. This account here, you could have, other companies would have probably debited sales. Some companies debit sales, others are using this debit called Customer Refunds Payable. Likewise here, we sold it, so we have to remove it out of inventory. In letter A, debit cost of goods sold, credit inventory. Here, we then debit the inventory, put it back, but rather, and other companies might have credited cost of goods sold instead. Cost of goods sold. Letter C, the receipt of the check. Well, the net of the $254,500 less the $30,000 is $224,500. So now we debit cash and we credit AR. And let's just finish with number 17 here. Based on the data in 16, journalize Balboa's entries for the purchase. Well, what did they purchase? $254,000 worth. $254,000. So debit inventory, credit AP. That's what they bought. Then they returned it. Reduce the AP, credit inventory. And then they paid it. It's the same dollar amount now, but they paid it and their AP goes down. So purchase, we charged it. Returned it, reduce what we owe, get it out of inventory, and then we pay what is due. We will stop there and pick up some more here in a bit.